Hi. Let's learn about the debt service coverage ratio, DSCR. The debt service coverage ratio measures a firm's available cash flow to pay current debt obligations. The DSCR shows investors and lenders whether a company has enough income to pay its debts. The ratio is calculated by dividing net operating income by debt service, including principal and interest. The debt service coverage ratio is a widely used indicator of a company's financial health, especially those who are highly leveraged with debt. Debt service refers to the cash needed to pay the required principal and interest of a loan during a given period. The ratio compares a company's total debt obligations to its operating income. Lenders, stakeholders, and partners target DSCR metrics, and DSCR terms and minimums are often included in loan agreements. The formula for the debt service coverage ratio requires net operating income and the total debt servicing for a company. Net operating income is a company's revenue minus certain operating expenses, not including taxes and interest payments. The total debt service refers to current debt obligations, meaning any interest, principal, sinking fund, and lease payments due in the coming year. Income taxes complicate DSCR calculations because interest payments are tax-deductible, while principal repayments are not. A more accurate way to calculate total debt service is to compute the following formula: TDS equals interest x, 1, tax rate, plus principal. The debt service coverage ratio reflects the ability to service debt given income level. Lenders routinely assess a borrower's DSCR. A DSCR of 1 indicates a company has exactly enough operating income to pay off its debt service costs. If the DSCR is less than 1, it denotes a negative cash flow, and the borrower may be unable to cover or pay current debt obligations without drawing on outside sources or borrowing more. Lenders may require the borrower to maintain a minimum DSCR while the loan is outstanding. The interest coverage ratio indicates the number of times that a company's operating profit will cover the interest it must pay on all debts for a given period. The higher the ratio of EBIT to interest payments, the more financially stable the company. The debt service coverage ratio assesses a company's ability to meet its minimum principal and interest payments, including sinking fund payments. Because it takes into account principal payments in addition to interest, the DSCR is a more robust indicator of a company's financial fitness. DSCR, like other ratios, have value when calculated consistently over time. A declining DSCR may be an early signal for a decline in a company's financial health. DSCR may also have comparability across different companies, and it is also a more comprehensive analytical technique when assessing the long-term financial health of a company. The DSCR calculation may be adjusted to be based on net operating income (EBIT) or EBITDA, potentially overstating the company's income. Another limitation is that DSCR is partially calculated on accrual-based accounting guidance, causing inconsistency when reviewing both a set of GAAP-based financial statements and a loan agreement that stipulates fixed cash payments. Let's say a real estate developer is seeking a mortgage loan from a local bank. The developer indicates that net operating income will be $2,150,000 per year, and the lender notes that debt service will be $350,000 per year. The DSCR is calculated as 6.14x, or the borrower can cover their debt service more than 6 times, given their operating income. The DSCR is calculated by taking net operating income and dividing it by total debt service. For example, if a business has a net operating income of $100,000 and a total debt service of $60,000, its DSCR would be approximately 1.67. DSCR is a commonly used metric when negotiating loan contracts between companies and banks. A business applying for a line of credit might be obligated to ensure that their DSCR does not dip below 1.25. As a general rule, a DSCR above 1.25 is often considered strong, whereas ratios below 1.00 could indicate that the company is facing financial difficulties. Here are 3 key takeaways. 1. The debt service coverage ratio, DSCR, is a measure of the cash flow available to pay current debt obligations. 2. Lenders use DSCR to determine whether a business has enough net operating income to pay back loans. 3. A DSCR above 1.25 is often considered strong, whereas ratios below 1.00 could indicate that the company is facing financial difficulties. Hope this would help. Thanks for watching.